Okay, so you want to own a cafe. Walk past one on a Saturday morning and the line is out the door. Someone's on a laptop in the corner, three people are waiting on oat milk lattes, the espresso machine hasn't stopped hissing in 20 minutes. Coffee costs pennies, and people are paying $6 a cup for it. Rent a small storefront, buy a decent machine, hire a couple of baristas, print a nice logo for the cups. How hard could it possibly be? Here's the question that scene never answers. Over 60% of Americans drink coffee every day. The U.S. coffee market just crossed $49.5 billion, and roughly 3,300 new coffee shops open every single year. So why did Compass Coffee, a 25-location chain in Washington, D.C., founded in 2014, one of the most recognized independent coffee brands on the East Coast, file for Chapter 11 bankruptcy in January of 2026, owing $11.7 million to creditors and landlords? The espresso machine isn't lying to you, but it isn't telling you the whole story either. A cafe isn't really a coffee business. It's a real estate and labor business that happens to sell coffee. And understanding that distinction is the only way to understand why a full line at the counter and a bankruptcy filing can exist in the same year. Start with what you're actually buying into, because a cafe covers an enormous range of businesses wearing the same apron. At the bottom, a coffee cart. No building, no seating, can get you into business for $16,000 to $49,000, breaking even in 3 to 6 months because overhead is almost nothing. A small counter service shop, 500 to 1,000 square feet, typically runs $80,000 to $300,000. A full cafe with seating and a real kitchen can run $175,000 to $400,000 or more before you've sold a single cup. And a drive-through only concept, increasingly common in suburban markets, sits somewhere in between. Smaller footprint than a full sit-down cafe, but real estate costs that rival it once you factor in the queue lane and pickup window infrastructure. Real estate and build-out eat 30 to 40% of the total. The line item first-time owners underestimate hardest. Cosmetic upgrades to an existing food service space might run $15,000 to $30,000. Converting a raw retail unit from scratch can climb to $80,000 to $150,000. Equipment is 20 to 35% of the budget. Commercial espresso machines alone range from $5,000 for an entry-level unit to well over $20,000 for a premium two-group machine. And that's before grinders, refrigeration, a point-of-sale system, and furniture for the seating area. Then there's what most owners forget entirely: licenses and food permits, $500 to $5,000. Security deposits running 1 to 6 months of rent. In a dense market, that alone can mean tens of thousands before a single chair is unpacked. And 3 to 6 months of operating capital in reserve, because most new cafes take 6 to 18 months to become profitable. And undercapitalization is one of the most common reasons cafes fail before they get the chance to succeed. Not because the idea was bad, but because the owner ran out of runway 6 weeks before the neighborhood finally learned the shop existed. There's also a decision most first-time owners underweight: buy an existing cafe or build from scratch. Taking over a space that already operated as a cafe means the plumbing and grease trap are already in place, and the previous owner's foot traffic history is at least a starting data point. Converting a raw retail space into a functioning kitchen from zero can push construction alone to $80,000 or more before you've hung a single sign, with no guarantee the corner ever drew coffee buying traffic in the first place. So why does anybody do this? Because a well-run cafe with a strong location can generate $500,000 to $800,000 a year, with net margins of 10 to 15%. The mechanism is deceptively simple. The markup on the drink itself is enormous. A coffee that costs the owner 50 cents in beans and milk sells for $4 to $6, gross margin north of 80% on the beverage alone. Food runs thinner, 60 to 70%, because spoilage is real and a batch of unsold pastries by closing time is a loss the owner eats every day it happens. Compare that to a full-service restaurant fighting for single-digit margins after food cost, labor, and rent, and it's obvious why coffee shops keep opening despite the failure rate. The beverage math alone starts from a dramatically better place than almost anything else in food service. Here's the counterintuitive part. The customer on a laptop for 3 hours, nursing one $5 latte, isn't ideal from a pure margin standpoint. They're occupying a seat that could have turned over 4 or 5 times in the same window. The seats are the scarcest resource in the building. Rent gets paid on the square footage, whether it's generating 4 transactions an hour or 1, which is exactly why so many cafes have shifted towards smaller footprints and faster counter service. Fewer comfortable armchairs, more standing height counters, weaker Wi-Fi passwords that quietly get changed every few weeks. None of that is an accident. It's the same real estate math running in the background of every design decision, whether the owner says it out loud or not. Now, the 2 costs that sit underneath almost every cafe failure. The first is labor. A cafe needs baristas covering opening, midday, and closing shifts 7 days a week, roughly 70 to 90 hours a week, even for a modest single location. At $16 an hour before overtime or payroll tax, that's $10,000 to $15,000 a month before a single bag of beans gets purchased. Add a manager's salary and the overtime that comes with covering a sick call on a busy Saturday, and labor routinely becomes the single largest recurring expense, larger than rent, larger than the coffee itself. Unlike a subscription business, a cafe can't quietly profit off customers who don't show up. Every dollar of revenue requires a barista physically standing at the counter to earn it, in real time, during the exact hours the doors are open. The second is rent, and this is where Compass Coffee's story begins. The chain had not paid rent on one DC location since January of 2025, eventually owing over $744,000 to one landlord alone, plus another $300,000 to a previous landlord elsewhere. Coffee shop leases run 5 to 10 years, signed when foot traffic projections look strong, often based on office occupancy numbers, foot counts, and demographic data pulled during whatever moment the deal was negotiated, which may bear little resemblance to conditions 3 or 5 years later. A cafe's entire revenue model requires that exact foot traffic to walk in the door every single day the lease is being paid, whether the neighborhood around it changed or not. Compass opened its first location in 2014 and expanded steadily for a decade, reaching 25 locations and 166 employees. It kept opening new stores as late as May of 2025, including one Adams Morgan location that had already housed a Phil's Coffee that closed in 2023, followed by a Foxtrot that folded in 2024. That's a location that had already told the market something about its foot traffic twice before Compass moved in. CEO Michael Haft was direct in the filing. Persistently low foot traffic at many locations, years after pandemic-era office attendance was supposed to recover. A cafe built around a downtown commute needs that worker physically in the building, and hybrid work permanently thinned exactly the customer base those leases were signed to serve. Some Compass locations stayed profitable. Others ran at a loss, and rent didn't care which category any store fell into. By January of 2026, with over $700,000 in unpaid rent at one location and $11.7 million owed overall, Compass filed Chapter 11 and auctioned its assets. 5 bidding groups, 24 rounds, 1 private equity bidder disqualified for lacking the capital to close. Employees and loyal customers watched a brand that had been part of the DC coffee scene for a decade get carved up and sold off piece by piece in a matter of weeks. The coffee was never the problem. What broke was the arithmetic connecting long-term rent to foot traffic that had permanently shifted. A smaller pattern is worth naming too. In November of 2025, the Blend Coffee and Cocktails, a Florida chain that grew from 1 St. Petersburg location in 2020 to 8 by 2024, filed its own Chapter 11 after rebranding to chase a bigger evening crowd with alcohol on the menu. Growth outpaced the foot traffic each new location actually needed to survive on its own economics. A 4th or 5th store opened on the strength of the brand's momentum, not necessarily because that specific corner had proven demand for it yet. Both stories trace to the same root cause. Not bad coffee, not bad service, not a bad brand. A gap between how many locations the brand's ambition demanded and how much real foot traffic each individual storefront's lease actually required to break even. That gap doesn't show up on day one. It shows up 18 months or 3 years into a lease, when the market that justified signing it has quietly moved on and the rent hasn't. So how does a cafe make money, mechanically? Revenue equals average ticket times transactions per day times days open, minus labor, minus rent, minus cost of goods. Typically 28 to 35% of revenue. Take a cafe averaging $6 a transaction and 150 transactions a day, roughly $27,000 a month in revenue, against $10,000 to $15,000 in labor, $5,000 to $8,000 in rent, and cost of goods eating another $8,000 to $9,000. That's a thin margin even with a line out the door most mornings. Push to 250 transactions a day at the same ticket, and monthly revenue climbs to $45,000 while labor and rent barely move. A single trained barista handling a well-designed morning rush can serve significantly more customers per hour without adding headcount, which is exactly why the real money in this business sits on the marginal transaction once fixed costs are already covered. In the optimistic scenario, you've picked a location with real, durable foot traffic. Not just a trendy block, but one with actual daily repeat customers. Kept labor controlled without sacrificing speed, and negotiated rent realistic to what that storefront can generate. That supports a 10 to 15% net margin on $500,000 to $800,000 in annual revenue. A genuinely solid outcome, enough to support a real owner salary once the location is established. In the realistic scenario, a neighboring office goes hybrid, a better funded competitor opens 2 blocks away, or the lease renews at a rate that assumed growth that never came. A barista quits mid-summer, and the replacement takes 6 weeks to find, forcing overtime pay to cover the gap. None of it looks like a crisis from behind the counter. The espresso machine still hisses every morning, the regulars still show up. It just quietly turns a comfortable margin into a break-even one, then a loss, right up until the rent goes unpaid long enough that a landlord files for judgment. The way it happened to a 25-location chain most people in DC would have called a success story right up until the week it wasn't. So, if you're thinking about opening a cafe, the line out the door was never the real business. The real business was always whether the rent on that specific storefront could survive a year where the line got a little shorter, and whether the lease you signed on your best day still makes sense on your worst one.